Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Downshift gains momentum. The Fed's Mary Daly warns about the lag effects of rate hikes, while Loretta Mester says 75 basis points is not needed next month. FTX fallout. Crypto firm Genesis warns of bankruptcy as it struggles to raise cash. U.S. prosecutors began probing Sam Bankman-Fried's empire months before its collapse. Plus, keeping the lid on oil whipsaws as Saudi Arabia denies a report saying OPEC Plus is weighing a production increase at its December meeting. Now, we have plenty of stories to get our teeth into, but first thing is first, let's check on the markets. The market's a little bit, if not subdued, certainly mixed. When you look at European stocks overall, the 600 index is gaining some 0.2%. But for example, the FTSE is not doing the same thing as the CAC 40. We'll get onto the European map in a second. Technology under pressure, down 0.8%. The picture not only is what happens in China, but many questions as we have about 3 to 4 Fed speakers later on that could give us a clue on the path of interest rate hikes. And of course, the other story is oil. Bitcoin also will have a full roundup of exactly what's happening with that Genesis going bankrupt, 15,703. What does it mean for the viability of cryptocurrencies in general for the future? All right, we talk about mixed stocks, so let's look at the difference, for example, between the FTSE 100, where you see a 0.7% gain compared to the DAX, 0.2% higher, but actually it was a lot more mixed just 15, 20 minutes ago, where you had some of the indices, including the DAX, on the downside. Now, a bit of a lift, so we're definitely onto today's highs. The FTSE MIB in Italy gaining 0.3%. So fresh turmoil in the world of crypto. Brokerage firm Genesis warning it may need to file for bankruptcy. That's amid contagion from the rapid demise of FTX, which has contributed to reduced liquidity in crypto markets. Now, the saga spooking investors, with Bitcoin trading around the lowest level since November 2020. Well, joining us now is Anna Herrera, Bloomberg's senior crypto editor. Anna, what exactly is going on? How many more companies could go under because of FTX?
We don't really know, and that's what's spooking investors, I guess, is that people didn't really think that this could happen to FTX. So someone told me last week, if you can't trust FTX, who can you trust? And now we're seeing something happening with Genesis. They're trying to raise, and they've warned their potential investors that if they don't raise, they might have to file for bankruptcy. And that's scaring everyone a lot, because Genesis, you know, is one of the hallmark crypto companies. They were a large brokerage. They brought in lots of Wall Street investors into crypto, and so then they became a lender. And so if they go down, you know, they are everybody's counterparty, which means that someone else might collapse, and that's sort of a chain that might never end.
And Anna, I know we're trying to get to the bottom of exactly what happened at FTX. When do we find out? I know there's investigations, regulators are looking into it too.
So everybody seems to be looking at it. Regulators in the U.S., even the company itself, now they have a new CEO. They're trying to figure out what happened exactly, if customer funds were used in sort of illegal ways, how they got into trouble in the first place, if it was like a trading host. So, you know, it's so much is known, so much has been written about this company, but so much still has to be figured out.
Anna, what happens next then in terms of timeline? What are you looking at for the next couple of weeks and then months?
Obviously, we're looking at Genesis now, seeing what happens there. And then, you know, we've already seen that from Genesis, there's been a sort of contagion into Gemini, the trading platform owned by the Winklevoss twins. They had to stop redemptions on their lending, on one of their lending products. So I guess we're going to follow and see sort of everywhere, really. There were also lots of hedge funds that had accounts with FTX, so we're going to follow there and see who some of the biggest creditors might be. There was a list that came out, but it was redacted, so we don't really know who the big creditors are.
Anna, thank you so much. Anna Herrera, Bloomberg's senior crypto editor, of course, on the fallout and the story that just keeps on unfolding in unexpected ways. Now, we're also joined by Hannah Smith, Vice President for State Street's ETF business. Hannah, thank you so much. Every time you come on, there's like a big news story. So I was thinking, like, you know, Hannah's coming on. What's it today? Do you have any exposure to crypto through any of the ETF funds?
No, we also, well, firstly, good morning, Francine. Thanks for having me on the show. We don't have any exposure. I think what we're seeing at the moment is there's still quite a lot of uncertainty within the crypto market. So I think it's, you know, we have to see how it plays out and what the implications are.
So today you look at markets, again, a bit of a mixed bag like we often have when you have a lot of Fed speakers and then the focus is on China and what happens with the oil price. Like, what do you think will be the driving momentum for the markets?
I think at the markets, obviously, the central banks have been driving a lot of the volatility that we've seen, and they've been really focused on bringing down inflation. I think what we're expecting is that's going to actually shift soon into more of a growth focus, the slowdown in growth and the implication that that's going to have. And so we sort of expect that rates are likely to peak in Q1 2023. And then we're actually anticipating cuts, typically 25 to 30 weeks after that, so around Q4 2023. That's our expectation.
And so given all of that, where do you put your money right now? What seems good value?
Yeah, I think it's really difficult right now. I think at the moment what we're recommending is to have underweight in equities at the moment. Equities aren't actually really pricing in much of recession risk. The PEs are still quite toppy, and so we would recommend sort of being underweight in that area. Overweight cash, given the yields that we've seen there, and obviously commodities, given the inflation environment. It's a similar story to what I discussed last time, but commodities as well.
Overweight cash, dollar.
Yes, exactly.
I mean, at some point the dollar, and there was talk about it kind of reaching peak and slowly coming down. Is this the time for it?
Yeah, I think I think given the weaker CPI number that we saw coming out of the US, it definitely feels like we may have reached the peak. But obviously one data point doesn't create a trend, and so we still need to see what the subsequent numbers are. And given the volatility that we've seen within the CPI prints, I think it's challenging, but we do definitely think that we are starting to reach that peak rate now.
Hannah, is there a misunderstanding of the markets that they see actually peak inflation, and is there maybe a belief or a longing for then inflation to come down, more quickly? And you have Fed speakers, that keep on saying, we'll have to raise interest rates again, maybe not as aggressively, but if we were going to hit that target, it will be quite painful.
Yeah, I think there's obviously a huge focus on peak rates, and I think the market is really on tenterhooks every time we have a CPI print, because it's really dependent on the performance of many asset classes, rates, and what the path is going to be from here. As I mentioned, I think that we are coming closer to that point, and I think the time to go pro-risk is probably when the yield curve starts to flatten. It's still inverted, and typically it stays inverted for 3 to 5 quarters. So we would expect it will probably flatten around mid next year, and that would be when would be the time to go pro-risk within equities.
So the Fed obsession is not abating anytime soon?
No, I don't think so. Wherever the Fed goes, the world leads, and so obviously there's a huge focus on the Fed, and as there should be. They've been laser focused on bringing down inflation, and that's their job, that's their credibility, and so the market is going to be watching that with a keen eye.
What are you buying on the yield curve?
I think on the yield curve, the long end of the curve is now looking very attractive. So given where rates are at the moment on the 10-year, I think that's kind of where the spot is, particularly if we're now reaching peak rates.
Hannah, when it comes to China, so again, we had the surprise, the market was pretty happy that it was opening and maybe we could have a more stable, or certainly putting aside the zero COVID policy. Doesn't seem the case. Yeah,
it's interesting. One thing that we say regarding China is watch what they do, not what they say. And so obviously last week we saw this rhetoric that perhaps there'll be a more soft approach to the zero COVID policy, and now that seems to have changed given the death that we saw more recently related to COVID. And so I think China's interesting. It's obviously trading very cheap versus the developed markets. Emerging markets in general are trading, I think, on the debt side at a 95 percentile. So they've only been cheaper 5% of the time. And on the equity side at a 40% discount to developed markets. So there's definitely attractive valuations. But as we know with emerging markets, valuations aren't enough of a catalyst. We have to see that zero COVID, a change to the zero COVID policy in order to give investors some reassurance that, that's not going to continue to damage the economy.
So you're not playing the China market right now?
I don't know, not at the moment.
Is there anything else in emerging markets that looks attractive? As you say, it's not all about valuations, it's also the path forward.
Yeah, absolutely. I think if investors do want to gain exposure to emerging markets, then LATAM, where they're huge commodity exporters, and so they can benefit from the rise in commodity prices. So that would be the area within emerging market, which looks more attractive. But obviously investors have to have the risk appetite for it.
Yeah, they certainly do. Hannah, thank you so much. Hannah Smith there, Vice President for State Street's ETF business. Stays with us. We'll talk about the UK and the EU shortly. Coming up, Fed officials have broadly maintained their steadfast stance in the fight against inflation. JP Morgan's Kalanovich, though, sees more downside risks until the Fed stops hiking. We'll discuss more of that next, and this is Bloomberg.
As we work to bring policy to what we call a sufficiently restrictive stance, which really in simple terms means the level required to bring inflation down and restore price stability, we will need to be mindful. Adjusting too little will leave inflation too high, and adjusting too much could lead to an unnecessarily painful downturn.
Well, that was the San Francisco Fed President Mary Daly speaking about the potential impact of Fed policy. Her Cleveland counterpart, Loretta Mester, said she's open to slowing the pace of rate hikes. And then JP Morgan's Klanovich says the Fed will have to start reducing interest rates for there to be sustained rally in risky assets, but that's not likely in the near term. Well, we're back with Hannah Smith, Vice President for State Street's ETF business. Hannah, we were talking a little bit before about inflation dynamics in the U.S. and the fact that, you said rightly so that one CPI number in October does not make a trend. It seems that inflation in Europe would be stickier anyway. Is that a fair assessment?
Yeah, definitely. Obviously, Europe has the implication of the Russia-Ukraine war. It's more heavily felt. And so the inflation there is definitely going to be slightly more stubborn than what we're seeing in the U.S.
So are you buying any, or are you, should clients be exposed to European equities?
European equities are actually really interesting because if you look at the valuations, they're currently trading at a 35% discount to the US. The average is around 70%. So if you look at that, we believe that there's a significant amount factored in for the Russia-Ukraine war, and so it could pose an attractive entry point. However, there is still a lot of uncertainty related to Europe. So again, it depends on investors and their risk appetite, but it is one to watch.
But what's the right entry point? I mean, how do you call it bottom, given all of the uncertainty?
Yeah, and this is the million-dollar question. I think, as I mentioned earlier, the peak rates could be, within the US, could signal, an interesting point at which to reassess there.
The UK, there's been so much going on, and I know every time there was a prime minister leaving or something happening, is now because of the, I guess, stabilization to some extent with the fiscal autumn statement, is it a good time to come into the UK assets? Yeah,
UK assets have had a really good run this year, and the reason for that is because they're very defensive in nature in terms of the sector allocation. They also have higher exposure to energy, consumer staples as well. In addition, the falling pound is beneficial as 80% of companies generate their revenues overseas. So the UK is a good defensive play, and it has performed relatively well.
What's your world of ETF right now? There's always, I guess, for years, so much, copy written about the fact that because of the tax incentives in the US, it's just such a bigger market compared to Europe. Are we catching up?
Yeah, Europe's definitely catching up. I think what we're seeing in Europe is that the investors are utilizing ETFs because of their liquidity, and particularly during this year, where we've seen so much volatility. When the VIX spikes, we do tend to see more flows into our ETF range. For example, after the CPI print, the US CPI print, we saw 2.7 billion inflows into the ETF, the UCITS, European domiciled ETF space, and so it definitely does respond.
So, Hannah, is it changing the nature of the market?
I think that it's providing additional sources of liquidity. So, for example, in the fixed income space, trading fixed income ETFs, they trade intraday, they trade on the secondary market. And so what we're seeing is when investors want to enter or exit the market quickly, or if they want to make tactical bets, then they utilize ETFs to do that because they're able to trade relatively quickly and with ease. And also the price point is attractive for ETFs as well.
All right, Hannah, thank you so much, as always, for coming on. Hannah Smith there, Vice President for State Street's ETF business. Now, coming up, chaos at Twitter leads Tesla into a tailspin. More on the world's richest man and his companies next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Alice Atkins. Hi, Alice.
Hi, Francine. COVID restrictions now weigh on a fifth of China's economy as infections continue to rise, undermining Beijing's call for more targeted COVID zero measures. More than 27,000 new cases were reported on Monday, near a record, with the southern manufacturing hub of Guangzhou the current epicenter. Many local authorities have been expanding expanding testing and shutting schools and offices despite recent directives to ease measures. Malaysia's king has summoned political leaders for an audience at the palace later today. Lawmakers from key bloc Barisan Nasional earlier informed the monarch that they don't support ex-premier Muhyiddin Yassin as Malaysia's next leader. The country's politics were thrown into disarray after the weekend snap polls led to a hung parliament. Italy has approved a €35 billion budget law for next year, including plans to raise a windfall tax on energy profits. The new budget, the first by Giorgia Meloni's right-wing government, will increase the windfall tax rate from 25 to 35%. Over €20 billion will be allocated to relief for families and businesses facing high energy prices. NASA's new Orion crew capsule has come within 80 miles of the moon. Its path took the spacecraft over the Apollo 11 landing site, where astronauts first touched down on the moon in 1969. NASA's uncrewed Artemis 1 mission launched from Florida last week, in a first step towards sending people back to the moon. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine?
Alice, thank you so much. Now, Elon Musk has laid off more Twitter workers from the sales side of the business, further trimming a headcount already diminished by cuts and resignations. Elsewhere for Musk, well, signs that China is increasing COVID zero curbs rather than moving away from them is adding to a litany of investor worries over Tesla. Joining us for more on Tesla is Bloomberg's global auto czar, Craig Trudell. Craig, I mean, what is going on? Like, I used to be obsessed with Elon Musk's tweets, but frankly, I just don't have the time because he's on it all the time, and Tesla's not doing great.
Yeah, I think the highly online CEO giveth and the highly online CEO taketh away, right? I think, absolutely China is a big concern for them. They've had to cut price recently, and there was a sort of bearish note late on Friday that maybe there's sort of concerns swirling in the market about the need for further price cut.
Yes.
We're seeing it become an even more competitive market, with even Mercedes last week doing a big price cut. And I think the sort of amount of tweeting that he's doing is just a very obvious signal to the market that he's extremely distracted and has his hands full with Twitter.
Yeah. So if you're a shareholder, you're probably not all that happy with your Tesla stock right now. What do you do about it? You're not,
and you're asking increasingly for a stock buyback. That's been the sort of buzz on of all places on Twitter. Elon's fans asking for the company to consider a big buyback. This was actually something that came up on the earnings call last month, and Elon addressed it in a highly unconventional way, sort of openly talking about the idea that the board is, deliberating over this, the possibility of a $5 to $10 billion buyback, being something that could be done. But he's also more recently referred to the idea that this is up to the board, so he's sort of, deferred to them.
So, I mean, what kind of timeline are we talking about if there is a potential buyback?
I think, the comment on the earnings call was 2023. I think, of course, that's going to be dependent on just how confident, management and the board are about cash flow and sort of the state of the business. And so, maybe this is a way for the board to signal confidence, but also it may be a little bit of, sort of there may be a bearish takeaway from this that, the stock, that the cash couldn't be put to use, in other ways. So it could cut both ways, whether they do this or not.
Great. Actually, Elon Musk and how he thinks, maybe more than most. Like, what's his strategy right now? I know every time I ask a difficult question also, which surprises me, on Twitter, there's always someone on Twitter that, tweets at Elon Musk as if he was going to tell us off. Like, is he now become the kind of the policeman of the world on social media?
I think he thinks that he seems to obviously think that he can cut to the bone here without really damaging the service. And, even if it's a sort of, car crash that he's putting on, it's going to attract eyeballs. I think the thing that breaks down for people trying to understand what he's doing here is how the heck he's going to turn this into a business that advertisers are interested in. I think, there are people in Silicon Valley who are willing to work for this guy, even if it is, a really difficult environment. Clearly, he's pulled this off before. But the big question at this point is, how the heck he's going to get advertisers back on the platform.
Yeah, but is there a danger that actually if he focuses too much on Twitter, then he forgets the rest?
Absolutely. And I think there's a question of, does he need to bring in help for one business or the other? Because Clearly there's a confidence problem on the part of both of these companies and the sort of intermingling of them.
Craig, thanks so much, as always, for coming on. Our Bloomberg Global Autos Tsar and Elon Musk whisperer, Craig Trudell. Coming up, we talk about the growth of gaming and eSports with the co-founder of Games Workshop, Sir Ian Livingstone. That's coming up next, and this is Bloomberg. Downshift gains momentum. The Fed's Mary Daly warns about the lag effect of rate hikes, while Loretta Mester says 75 basis points is not needed next month. FTX fallout. Crypto firm Genesis warns of bankruptcy as it struggles to raise cash. U.S. prosecutors began probing Sam Bankman-Fried's empire months before its collapse. Plus, keeping the lid on oil whipsaws as Saudi Arabia denies a report saying OPEC Plus is weighing a production increase at its December meeting. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, let's turn to the UK. Prime Minister Rishi Sunak addressed a meeting of the country's biggest employers yesterday, doubling down on his Brexiteer credentials.
Under my leadership, the United Kingdom will not pursue any relationship with Europe that relies on alignment with EU laws. Having the regulatory freedom to do that is an important opportunity of Brexit. And that's my agenda, and I'm confident that that agenda is not only right for the country, but can deliver enormous benefit for people up and down the UK in the years to come.
So we'll get back, of course, to Birmingham and the CBI. Let's now talk to a living legend of the global video game industry. He's Ian Livingstone. He received a knighthood for his services to the UK's gaming sector earlier this month. Now, he co-founded $2 billion game companies, GamesWorks and Eidos, the latter the company behind Lara Croft Tomb Raider. Now, an angel investor, Ian is general partner of the gaming VC fund Hero Capital, and we're very pleased to welcome him on Bloomberg Surveillance Early Edition. Sir Ian, there's so much to talk about. First of all, thank you so much for coming in. Look, the gaming industry is one of the big booms that we've seen over the last 10, 15 years. If you're a gamer, you live it, you breathe it, you don't talk about anything else. Maybe for outside investors, it's not something that you spend a whole lot of time on. How does the metaverse change this?
Well, the games industry has risen to a state where it's a $250 billion industry, some 3 billion people play it. Every time there's an advance in technology, it offers a new platform for games to be enjoyed. So it was originally PCs and consoles, and Facebook became a platform. Smartphones obviously became a huge platform for casual games, and then VR, AR, eSports, and now we're talking about the metaverse. But it's the games industry that's actually built the metaverse. I mean, games like Fortnite, where you don't just play together, you hang out together, you can transact together, you can go and watch a Travis Scott
concert together.
Concert together. So it's a place where the digital world can meet the physical world.
So how much bigger do you think the game industries, can actually be in the next 5, 10 years? The numbers, were we over-optimistic about how big it could get and how quickly, or are we underestimating it?
I think people have always been surprised that, no one talks about it because we don't have celebrity like film or TV or music. There are no kind of video game stars. They're all virtual. And in the UK particularly, we've created some of the biggest franchises in the whole world, but people don't know that. They think they come from the States or China or Japan. But it's set to grow because it speaks to Generation Z, because everything they do is interactive, the prolific use of social media, they live their lives together with their friends, and guess what? They want their entertainment to be interactive. So, of course, games speaks to that. It gives them agency and control, so they want to be in control of their entertainment as well as, instead of just being a kind of passive receptor of whatever you're fed by a director.
I mean, when you started Games Workshop,
Yes.
I know you were telling me what it was like, which was tough, right, for a couple of years, but what did you see in the future that others didn't?
Well, we started off in 1975, and we kind of made it up as we went along, loads of mistakes. Had to live in a van for 3 months. You go to a bank manager and say, I've got this great game, it's a role-playing game, and he looks at you rather like a dog watching television, has no understanding whatsoever what you're talking about. But we were passionate about play. I mean, when you arrive in this world as babies, you interact with that world. You learn through play. And I think it speaks to us as human beings, that's kind of social aspect. So I could see that the game industry was bound to grow once it got enough games that spoke to everybody.
But the pace of change is incredible, right, in the gaming industry over the last 10 years because of our devices and VR and things like that. Is that pace of change going to increase even more? And what does it mean for putting capital at work where companies will become the next big thing?
Well, there's been a disconnect between the makers and the money. I don't think games companies have always been investor ready. They don't know how to speak to the money.
Yeah.
And I don't think the money really understood what good looks like. So I think there's a much greater engagement because, what makes a good game? The investors don't really know what that, but it's about investing in teams, not just the game. When people ask me what's the 3 most important things about a game, I'll say gameplay, gameplay, gameplay. Technology and graphics play a critical but supporting role, but it's the team that is so important. Those who've actually done it before, got some skin in the game, got some technology, got some intellectual property, and they've failed before. And so you leverage all their expertise, and likely as not, they're going to be successful one day.
So if you're a good investor, you're either a gamer or you have in your close vicinity someone who can test games for you.
Well, you don't have
the next big thing.
You don't have to be a gamer, but you need to have somebody on your team who really understands that. I mean, there are incredible success stories. Like there's a company in Wilmslow that I put some seed capital into called Playdemic. It's generating $200 million top line revenue per annum, 100 million EBIT. And the company ultimately sold to Electronic Arts for $1.3 billion. There's only 80 people in that company. I don't know of any other industries where 80 people can generate that kind of enterprise value. And so post-COVID, the games industry ticks all the right boxes for success. It's intellectual property creating, high salaries, high tech, regional, which speaks to the government's wish. It's an instant export story because it's access global markets through whatever digital platform. And there's no
red tape, right, to export it because it's on digital platforms.
Exactly. So you can connect directly. It's a kind of business to consumer proposition.
Is the UK losing its star somewhat? It used to be, or have a lot of developers also from the outside. And I don't know whether it's a cost of living crisis, Brexit, maybe weaker pound, that will hurt that.
Well, the games industry in the UK has always been successful. There's some 2,000 studios here. Most of those are micro studios, but some of the biggest franchises in the world, from Grand Theft Auto to Tomb Raider to Fall Guys to Golf Clash, have all been created here. The common denominator, sadly, some might say, is that they're all foreign-owned. So whilst it secures inward investment and jobs, a lot of the profits is banked overseas. So I'd like to see greater investment in the UK in particular, so they can go further up the value chain of IP ownership.
What's your favorite game right now that we haven't heard of?
Well, that's been like
we're getting on to Christmas.
That's a bit like asking what's my favourite child now.
Which we all have one.
So, I mean, I'm old, so I can only play strategy games. So I play games like Civilization. There's a lovely little pixel game called Kinsey coming out soon. The usual hits will always be the new FIFA games will be extraordinary. It's whatever you enjoy playing yourself, because it's whether it's single player, multiplayer, and whether you want dexterity or just strategy, it's up to you. There is something for everybody now.
As a venture capitalist, how hard is it to have one game that's very popular for a company to come up with one game that does amazingly well, and then to build on those successes? Some of the companies are a one-game wonder.
Yeah, but it's a great one to me. I mean, games like Candy Crush and Clash of Clans, they've been running for 10 years now. So it's games as a service, and they're optimized over time through analytics and data. So understanding consumer behavior, improving the monetization, the retention, and giving them more of what they actually enjoy doing inside a game. You can really move it from being, the risk profile of the games has changed dramatically, because it used to be a premium price product in a physical box, managing the supply chain to get to ultimately to a consumer in a retail store, and if that game wasn't as good as people expected, it'd come back in returns. Now you can address the global market and run it as game as a service, optimize it through data, and you can get 2, 3, 4, 5, 6, 7 years of revenue out of that game.
In WhatsApp groups of mothers all over the world, the one question is, how do I get my kids off some of the gaming because they want to do it 24 hours a day? I mean, is there an advice? Like, what happens?
Well, anything you enjoy doing, you want to do it a lot. I mean, I know people would play golf 7 days a week if you allowed them. You have to manage people's time.
Yeah.
it's a responsibility of adults in particular to manage their children's activities.
Do you see China coming back? And actually, there was a lot of regulation for Chinese to limit the amount of time they spend on screen and gaming. Do you think that it will reverse at some point?
Yeah, absolutely. Definitely. I mean, I know several Chinese games companies, Tencent in particular, because they acquired Sumo Group, which I was chairman of until January this year. And there's definitely a mood now to relax some of those constraints.
All right, really interesting. Sir Ian Livingstone, thank you so much for joining us today. I hope it's just one interview of many to come. Co-founder of Games Workshop and general partners at Hero Capital. Now let's get back also to the CBI conference. Bloomberg's Lizzie Burden joins us from Birmingham. Lizzie, opposition Labour leader Keir Starmer's turn to address the meeting today. So what's he expected to say?
Yeah, Keir Starmer's about to speak any moment now, Francine, and he's expected to say that the UK is over-reliant on immigration to boost its growth, and therefore he wants to end this era of low pay and stop the reliance on cheap labour. But of course, we've heard this time and again, in fact, from various Conservative prime ministers. So the question really is going to be, how can he do that? Can he convince the room full of business leaders that he's got a plan to make things any different? And in fact, I was speaking to the CBI president, Brian McBride, earlier. He said that we do need some low-skilled labour in the UK, like the baggage handlers. And he also said on the growth question that Labour would face many of the same fiscal constraints that the government has faced. And that means it's going to be even more difficult to balance fighting inflation with driving the economy. But growth is what the CBI wants to see.
Lizzie, thanks so much. Lizzie Burden there at the CBI conference in Birmingham. Coming up, it's a circle of life. Bob Iger takes his first steps to reshape Disney after returning as chief executive officer. We have all of the details of the turnaround. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, it's a whole new world at Disney. Well, Bob Iger got straight back to business after making his surprise return as chief executive, taking the first steps to reshape the media giant. Now, for more on all of this is Alex Webb, who leads our tech and media coverage for Bloomberg Quick Take. I dare you to sing all of that. It's a brave new world.
Don't tempt me.
Don't tempt me. Alex, when you look at it, feels like actually he has a plan and he needs to strike hot.
Yeah.
Like, what does it tell you about what's been happening in the last couple of months?
Well, it hasn't been shining, shimmering, splendid.
In singing, please.
No. So, look, what's happened is that early in the pandemic, activist investor came in, said to Disney, you need to cut the dividend, invest that money in content for Disney+. Netflix was trading at 50 plus, price to forward earnings. Disney was trading at 25-ish. In doing so, it became a growth stock, essentially, and its earnings valuation overtook that of Netflix. Now, since then, we've seen growth stocks punished as interest rates go up. Netflix has come down, Disney has come down with it. At the same time, there's been a huge amount of internal disgruntlement, partly because creative decision-making has been taken away from TV studio leaders, film studio, all that sort of thing. So what the first step we're seeing now from Iger is
giving that back. So that was a mistake. So is this basically him trying to fix the mess of the person that's been charged for 2 years? Or is it a different strategy?
It seems as though he's kind of righting the ship a little bit. You know, there are two pieces to this, clearly. There's, as I alluded to, the kind of investor element. They've lost a little bit of confidence in the company. At the same time, internal morale also been suffering. So what we've seen now, he a memo to employees, which went out yesterday. Bloomberg's obviously got it. It's fixing the second piece. It's fixing the internal morale. What then happens on the investor side, we're yet to see. You know, Disney had completely scrapped the dividend. It's been reintroduced. It's about 20 cents per share at the moment. Prior to the new strategy where they pivoted towards Disney Plus, it was closer to 90 cents. The question is now whether Iger continues to invest in Disney Plus and just sells the story better, or it reinstates a higher dividend.
But is there a problem going forward? And you know, Bob Iger, and we saw the share price up 10% yesterday. Now, so intrinsically, you know, the name of Disney, that it's going to be difficult going forward to recruit anyone else.
Not necessarily. I think that, you know, look, Disney is still the biggest studio in Hollywood. It has Fox, all those Fox assets as well. It's got these vastly successful franchises. The difficulty they have is that the old cable model, which is really what printed money for them, ABC, ESPN, were the hugely profitable parts of their business. One of the reasons those things are so profitable is because the way that cable works, you would have 18 to 2-year contracts. That money would flow through the cable operators to Disney. Now, with the direct customer streaming service, from month to month, the customers can churn out. They can say, actually, do you know what? I don't want Disney Plus. That means you've got to invest really heavily in content to keep the bait going, to reel them in and ensure they're continuing to pay for it.
Alex, with Bob Iger back, does it put much more pressure on rivals?
Potentially, ultimately, there's a huge bun fight for the best IP, the best intellectual property in terms of scripts, directors, talent. Disney is the big beast in the middle of that. It's maybe had a slightly rough few months, but ultimately, Chapek wasn't in the job that long. And if you think about the cycles, how long it takes to make a movie, there could well still be films that are yet to be released that were ultimately greenlit still by Iger a few years ago. So, he's not really been there long enough to cause substantial damage.
Brilliant. Alex, thanks so much. Alex Webb there, who leads our tech and media coverage for Bloomberg Quick Take and did not break into song and dance. Let's get straight to your Bloomberg Business Flash. Here's Alice Atkins. Hi, Alice.
Hi, Francine. SocGen and AllianceBernstein have agreed on a partnership that merges large parts of their equities trading businesses. The joint venture will be run out of London under the Bernstein name and will unite the cash equities and equities research units of the two firms. The French bank will hold 51% of the new business. Elon Musk has laid off more Twitter workers from the sales side of the business, further trimming a staff already diminished by cuts and resignations. Last week, the billionaire asked workers to commit to his more hardcore version of the company or leave the business. Almost 5,000 staff have quit or been fired since Musk's takeover. Enel is to sell off assets worth 21 billion euros to cut debt. Italy's biggest power company has maintained its adjusted net income target for next year between 6.1 and 6.3 billion euros. The company had already reduced its guidance for this year, citing the effects of the energy crisis in Europe. Enel's debt hit a record of almost 70 billion euros at the end of September. That's your Bloomberg Business Flash. Francine.
Thank you so much, Alice. Coming up, we're back in Qatar as controversy continues to cast a shadow on the Football World Cup. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the first full day of the 2022 World Cup in Qatar saw Iran versus England, the Netherlands against Senegal, and the U.S. play Wales. So the tournament in full swing, but not without more controversy. Well, Bloomberg's Simone Foxman joins us from Doha now. Simone, the England-Iran match was a key focus yesterday. How did that play out?
Yeah, well, there weren't signals of support for LGBTQ after those armbands were banned. Those rainbow-colored armbands were banned. But we did get a surprising show of support from the Iranian team for demonstrations back home. The team did not sing the national anthem. Perhaps we should have known this because the captain on a Sunday night press conference mentioned how he wanted the team to be a force for good, but many of us surprised watching this to see so stark a statement from a team that's so typically been associated with the regime. And in the stands, we got a measure of how much of the protests are impacting the spectators as well. Many came out with Persian flags. Some of those Persian flags were confiscated, it sounds like. Others were singing the Persian anthem, note not the Iranian anthem. And then others had banners reading "Women, Life, Freedom," the slogan that has been so closely associated with those protests just across the pond in just across the Persian Gulf over in Iran.
Yeah. So, Simone, yesterday we saw 7 European teams say they wouldn't wear rainbow-colored armbands, which is exactly what you were just talking about and walked us through, some of the reasons for that. Overall, is a sense that the tournament in Qatar will just crop up with controversies every day, or are you expecting things to settle down a bit?
Yeah, on this issue particularly, shows of support for LGBTQ rights. I think this is one we may start seeing again and again. So we talked about that armband story, how FIFA essentially threatened sporting sanctions for players who wore these armbands. And then we heard about the situation of several fans who were turned away from particularly the USA-Wales game for wearing rainbow-colored hats, a shirt with a rainbow on it. It doesn't seem right. Organizers have said these displays should be allowed within the stadium, but what we're clearly seeing from security is that that is not necessarily being enforced. We've also heard perhaps of some scuffles on the ground essentially around this issue. I think this is the issue that's going to crop up as more people pour into Doha, as it gets busier here.
Simone, thank you so much. Simone Foxman there in Doha with the very latest. Now, Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller and Kailey Leinz in New York, Anna Edwards in London. Now, the picture for the markets is an interesting one. So let's see if we can get the boards up. Again, quite a lot of Fed speakers over the next couple of hours. Now, because of this, we started the day with a mixed bag in terms of stocks. Now, if you look at what the momentum is for a lot of stocks, they're gaining. Oil majors are also rallying. The European stocks 600 overall gaining 0.9%. Shell, BP amongst the biggest drivers. I'm also looking at, for example, U.S. pre-market trading. Zoom Video falling, though, after reporting slower sales and trimming its full-year revenue forecast. The dollar weakening against all major currencies, Treasury yields declining. The other thing in focus is, of course, these Fed officials broadly maintaining their steadfast stance to fight against inflation. But we heard from Loretta Mester and Mary Daly. So the San Francisco Fed President, Mary Daly, saying that officials need to be mindful of the lags in the transmission of policy changes. Her Cleveland counterpart, Loretta Mester, saying she's open to slowing the tempo of rate hikes. Let's also have a look at some of the groups that are on the move the most. Now, it's very clear that oil, coming up trumps when it comes to some of the biggest gainers that are on the move. Gold also rising on the weaker dollar. Of course, cryptocurrency. I mean, where do we start? Cryptocurrency, our biggest story of the day. Prices there are a little bit mixed. Investors bracing for more ructions as further digital asset sector bankruptcies could be looming following the demise of FTX. Energy coming up trump. Basic resources, travel and leisure gaining between 3.8 and 1.4%. I only see consumer goods slightly on the downside. So it does seem like there's momentum picking up for a lot of these stocks in Europe. We'll have a full roundup, not only of the Fed speakers, but also on markets throughout the day. This is Bloomberg.
Crypto going down, will be sub 10,000 on Bitcoin. I think that actually potentially happens even this year.
It's the lowest it's been since 2020, and I think it's the highest it's going to be for years to come. The vast, overwhelming majority of participants in crypto are speculative investors who are just looking for a quick win.
We've seen a failure of the financial services industry around crypto. And that looks like a liquidity crisis and a liquidation cascade. It's extremely damaging, but it is not reflective of the underlying economy that's being built in crypto.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. More fallout from the collapse of FTX. Digital assets brokerage Genesis is warning that it may need to file for bankruptcy if it can't raise new capital. Societe Generale and AllianceBernstein are teaming up in a new partnership. The two will merge large parts of their equities trading businesses. And Bob Iger takes her first steps toward reshaping Disney. Iger wants his deputies to rethink the corporate structure, and he announces that a top manager is leaving. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, from a European markets perspective, a focus very much on oil prices and oil stocks. Crypto still in the headlines, but the macro backdrop still very topical.
Yeah, and on the subject of that macro backdrop, Anna, we are just getting some breaking headlines out of the OECD publishing their new growth forecast for 2023. They expect growth to slow to 2.2% next year. That's down from 3.1% forecasted for 2022. And of the big G7 economies, they expect the UK growth forecast will be the weakest over the next 2 years. The chief economist at the OECD saying that fighting inflation still must be the top priority, even as we are faced with slowing growth, and goes on to say that further monetary policy tightening is, quote, essential. So again, 2.2% growth forecasted for next year from the OECD. And of course, the growth picture in China in particular is what Asian markets continue to focus on, as was the case overnight, where it really was a mixed session for equity markets. You had markets like Japan higher, which lifted the MSCI Asia Pacific Index higher by about 0.4% overall, but still seeing the weakness in Hong Kong and Chinese tech stocks listed there, especially the Hang Seng Tech Index down about 3% overnight. Interesting to see, though, that the yuan is still strengthening against the U.S. dollar today, although pretty much everything is stronger against the U.S. dollar on this Tuesday morning. The yuan stronger by a little more than 0.5% to just shy of the 714 level to the dollar, and the Japanese yen strengthening as well, trading at 141.28, Matt.
All right, I'm taking a look at S&P futures that are climbing by a bit right now, just up about 0.25%. A lot of green on this screen, but don't be fooled, because on the second row here, we have a color that should be red, actually. Basis points, 3.5 basis point drop on the 10-year yield down to 379.32. Of course, that's green because bond traders want to know if their price is going up or down, but this is showing the yield with a down arrow. NYMEX crude right now up 0.5%. We're seeing Brent rise about 0.5% as well. Not huge moves in the energy sector if you look at it from a zero basis. But if you look at the big swings that we've seen, it makes a huge difference, which is why, Anna, I'm sure you're focused on energy being a huge gainer in the European market. Interestingly enough, if you look at the Stock 600, tech stocks are down. So that doesn't fare well for U.S. futures, even though we have U.S. cash trade, even though we have a gain in futures. Bitcoin right now is up about 1/3%, but still at 15,681. So this is the lowest level, as you heard Patrick Armstrong saying, sort of gloating about at the top, that we've seen since 2020. But it's crazy because to me, it feels like we should be at a decade low, right? We're only at the lowest level that we've been in 2 years on Bitcoin. So even though we're down under 16,000, it just doesn't feel that bad to me. Anna, what do you see in terms of Europe?
Yeah, let's have a look at the European picture. And as you rightly point out, Matt, a lot of focus on energy names. The bright green of Spain down here, the UK also not doing too bad. And both of those have some weighting towards energy stocks. In particular, the energy names on the rise because, of course, we saw that wild swing that Matt was talking about there in oil prices yesterday around the time that European equity markets were closing up. And so Europe has some catching up to do perhaps on that. But also, European equity markets were more lackluster than this. Since we've seen US futures pick up a little bit, that has allowed risk appetite to increase here in Europe as well. Let's have a look at where we are on energy stocks then, up by 3.7% on those energy names. As we've seen the oil price, and this is Brent here, 87.73. We dropped as low as 82 in session yesterday on those reports around whether Saudi Arabia was going to increase production. Saudi Arabia came out and denied that, said no, we're not planning that. And OPEC Plus is, of course, biased towards cutting. That has been their most recent action. We have a meeting from them shortly. So that is going to be the focus of things. So that taking the oil price back up to where we started, essentially, back up to $87 a barrel. But the volatility was intense in the meantime. Societe Generale, we mentioned this is in the headlines, the French bank, the stock not on the move very much, but a really interesting story which we'll get more details on in a moment. This is SocGen tying up in a joint venture for its equities part of the business with AllianceBernstein, and it is to do with cash equities. It's also to do with equities research. It's going to be a business based in London, interestingly. And Enel is up by 1.7% this morning. The energy major over in Italy, they've been on a deal spree. They've been buying up renewable energy assets. They now have a big debt pile, and they're going to have to sell off some of those assets. So reducing their exposure in South America and also in Eastern Europe, Matt.
All right, we're going to talk about a couple of those stories right now. But I want to get first to the crypto story. The brokerage firm Genesis warning it may need to file for bankruptcy unless it can raise a heck of a lot of money. $1 billion. Emily Nicole, reporter, Bloomberg crypto reporter, joins us now for details. So what's the latest we're hearing about Genesis and the continued fallout from FTX?
Well, it's as you said it, Matt. They're warning investors now that if they don't secure the $1 billion loan that they're after, that they may have to file for bankruptcy, which would make it just the latest in the names that we've seen so far this year: FTX, Celsius, Voyager. But they're obviously still hoping that that's not the case. Spokespeople told us that that really is a last resort. At present, they're still talking to potential investors about that $1 billion loan. We reported that Binance was potentially involved in the talks at some point, but a spokesperson for Binance declined to comment any further on that.
Okay, so there were these talks with Binance, perhaps. Good to see you, Emily. We're now hearing that FTX, back to where this story, well, I was going to say started, didn't really start with FTX, but certainly a big recent participant. We're hearing that FTX has $1.24 billion in cash across all its entities. Does that improve the situation? How does that sit in relation to expectations?
It's a slight confidence boost for creditors, I bet, because, on Saturday they had filings from FTX that said they only had about $560 million in cash. So that's only a matter of days, and they've managed to double the amount. But it definitely shows that it's really proving to be a headache for those trying to manage the bankruptcy process for FTX. There are more than 130 entities that the group owns. There are disparate bank accounts, some that they've been able to identify and verify, some that they've been able to identify but not verify the cash inside them, and more bank accounts that they're sure are out there but they don't even know of or where they are. And so it does seem like this will be a pretty drawn-out process to see whether or not FTX does have enough money to be able to repay the creditors that are on its lists.
All right, Bloomberg's Emily Nicole, thank you so much. And on the subject of FTX, not even celebrities are immune to the fallout from its collapse. Sports stars, including Tom Brady, of course, of football, and Steph Curry, the basketball star, are among the big names a Texas regulator is investigating over potential securities law violations tied to their promotions of FTX. The state securities board says it's looking at payments they received to endorse FTX US, along with what disclosures were made and how accessible they were to retail investors.
Are you gloating?
Well, for the record, Tom Brady, I am not his biggest fan, so that is why Matt asked that question. And we can continue this conversation, Matt, and talk more about the broader fallout from FTX later today on Bloomberg Crypto with Matt and myself. 1 p.m. New York time, 6 p.m. in London. We'll be speaking with Chainalysis co-founder Jonathan Levine and Circle CEO Jeremy Allaire. Anna.
Okay, so that's the story around crypto. SocGen and AllianceBernstein, as I mentioned earlier, are merging large parts of their equities trading businesses. Bloomberg banking reporter Stephen Aarons has been covering this story for us. Steve, very good to have your thoughts on the program. So what exactly is happening then by the putting together of these two equity parts of the business?
It's an acquisition.
Yeah, well, it's a JV, first of all, but SocGen will have the majority stake. It will own 51% if the deal actually happens. Said they expect it to close before the end of next year. They will hold for 51%, but they have an option of buying the entire thing within 5 years. So they will actually have the option of becoming a really big player in equities or boosting their already sizable business. Clearly seeking growth here, especially after BNP, the big sort of arch nemesis, if you will, in investment banking in France for them, has already grown extensively, buying stuff. And so, I think they're trying to keep up with the competition here.
I am of the school, Stephen, that the word merger is a PR spin term. There is no such thing. This is an acquisition, which is why SocGen comes away with 51%. What does it mean, though, for the competition?
Yeah, okay, I give that to you, actually. On the competition, BNP, as I said, they've been buying. As you may remember, they bought the prime brokerage business from Deutsche Bank a couple of years ago. And they also sort of took on clients from Credit Suisse when they pulled out of prime brokerage not too long ago in the wake of all the scandals they had. So they've been growing quite substantially. It's been quite successful for them, how they've been expanding the equities business. Many European business sort of investment banks are pulling back, and BNP has become bigger, and now it seems like the incoming CEO, at SocGen, his name is Slavomir Krupa, he's the current investment banking head. It seems he's got big plans to expand now business for the bank to make sure it doesn't fall behind.
All right, Stephen, great story. Thanks so much for joining us. Stephen Aarons runs our bank coverage out of Frankfurt. Now let's get to the media story. Disney's returning CEO, Bob Iger, taking his first steps toward reorganizing the entertainment giant. Iger has asked his top deputies to rethink the corporate structure to their benefit. Guggenheim's Michael Morris spoke with Bloomberg yesterday on his outlook for Disney under the new old leadership.
I think that this company needs to really refocus itself on its Disney branded content more than anything else and right-size its spending to maximize that value, as opposed to just sort of growing a subscriber base without necessarily the type of profit objectives that I think a great company like this could achieve.
Alex Webb of Bloomberg Quick Take joins us with the latest on Iger's plans. So what do we know so far? It's only been one day, right?
Yeah, we've seen a memo that he has sent to the employees in which he outlines plans for a reorganization, which ultimately seems to be taking it back to the old structure. There had been a push by Bob Chapek to take a little bit of decision-making power away from the TV and studio heads. There was a certain amount of disgruntlement about that. The creative abilities or creative oversight they had was diminished. That was seemed to have been poor for morale. So he's trying to fix the internal problems, the communication with the markets, and therefore the share price. That has to come at some stage as well, whether he will increase the dividend and perhaps decrease the spending on Disney Plus, as we just heard the Guggenheim Partners team saying. That remains to be seen, but that's something that investors might be looking for.
OK, I'm sure there'll be no shortage of people with ideas as to how they should change the business, and we heard just one of them there in the introduction, Alex. What about key movement of personnel then? We're hearing about one particular executive leaving the company. What does this tell us, if anything?
Yeah, we've seen some the top ally of Chapek seemingly leaving, the head of the kind of media distribution arm, I think it is, and it seems as though maybe some power had been pulled towards him as part of this decision-making creative process. Now, that is kind of being undone, and we're seeing Bob Iger, as we say, go back to this old model that he had before, the one that seemed to work for him so well. Now, the thing is, this is a slightly different situation now from the company that he left. When he left Disney, they had Disney Plus. They weren't kind of all in on Disney Plus in the way that Chapek was, because there had been an activist investor came in early in the pandemic, and they had said, cut the dividend, use the capital to invest in Disney Plus, turn the company into a growth stock similar to Netflix. The valuation was rewarded as a consequence. The price to earnings ratio overtook that of Netflix. But since then, we've seen growth stocks punished. The valuations of both those companies have come down. So for all of the internal stuff to do with the creative process, ultimately, there's capital allocation issues, which are really what the market's going to be looking at.
All right, Bloomberg Quick Takes, Alex Webb, thank you so much. And what Alex was just talking about, how growth stocks have started to fare differently, how things have changed since the pandemic, is translating to another stock I want to pay attention to in pre-market trading this morning. That would be Zoom. Reported its slowest sales growth on record and trimmed its full-year revenue forecast, really showing how those stay-at-home pandemic darlings have seen their fates change in a dramatic way in the aftermath. This stock is down 85% from its peak in October of 2020, and it is adding to those losses this morning after its results, down about 9% before the bell. Another stock moving fractionally lower that is worth, actually now higher, GameStop up about 0.7%, but this is after a loss of about 9% yesterday. Of course, it has been wrapped up in the FTX saga. Also, we got news overnight last night that Carl Icahn has built up a large short position in this stock, so that is one to watch. And another stock I've just been watching over the last several weeks is Tesla. There are a number of headwinds at play here, including its China business, with now about a fifth of the Chinese economy equivalent on lockdown. Also, the fact that Elon Musk seems pretty distracted by Twitter. So this is a stock down more than 20% in the month of November so far, but a little bit of recovery happening this morning with the stock up about 1% before the bell, Anna.
OK, let's get back to where we started this hour, in fact, Kailey, in the news around the OECD. The OECD just released its latest economic outlook, predicting global growth will slow to 2.2% next year. We'll be hearing from the OECD's acting chief economist next hour. That's at 6:30 a.m. in New York, 11:30 a.m. in London. This hour, we'll speak with Anna Stupnytska, the Fidelity International global macroeconomist. What does she make of the OECD's assessment? How ahead of the market or otherwise is that assessment of growth for next year? What does she make of the UK lines, comparing them to the G7? This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. I'm looking at volatility, and it's surprising to me that we've seen, we've all seen and felt this huge uptick in bond market volatility. That's this blue line here. In FX volatility, that's this yellow line. For those of you listening on radio, those lines are higher. A line that is lower is equity volatility in white. Why isn't it keeping up? Joining us to talk about this is Priscilla Azevedo Rocha, Bloomberg credit reporter. So Priscilla, how come bonds are seeing so much volatility when we're not really feeling it in the equity indexes?
Well, hi, Matt. So bonds, they, like the moves in markets, they permeate slower through bonds when compared to equity markets, right? In equity markets, they react to headlines faster than bonds. So in bonds is literally the result of a year of really bad returns for investors, and that's what we are seeing.
That's what we're seeing then at that level. What about the big macro picture at the moment, Priscilla? Update us on where we've got to on the whole Fed expectations saga around the terminal rate and how much hiking there is still to go. Yesterday we heard from Mary Daly emphasising the need to consider lags, but even she was saying that doesn't mean, you know, we're done with hiking rates, there's more hiking to come.
Yes, that's right. So basically investors, they are looking at the broader picture, right? Because you have a lot of volatility in markets still, and you need to look at the broader picture instead of particular comments, because otherwise you'll be trading on the headlines. So investors, they are focusing on the Fed's ultimate message, which is to contain inflation.
And when we talk about containing things, Priscilla, if we could speak about China for a moment, because I noticed in the Bank of America Fund Managers survey that came out last week, when people were asked where the biggest risk of a credit event emanating from, the answer was China. China has taken steps to shore up the property market. We thought they were moving toward reopening. Now there's some question marks around that as COVID cases rise. Just what does risk look like in that market in particular at the moment?
Risk is still very much elevated. As you said, they're doing things to contain the property market, and this is very positive for investors. But at the same time, questions linger around the reopening schedule, right? We've seen this morning headlines that this might be pushed post-winter when COVID infections go higher and there's more risks there. So we are still unsure about the timeline and when we're going to see China opening again.
Okay, thanks very much, Priscilla. Bloomberg's Priscilla Azevedo Rocha with the latest on credit markets and beyond. For more market analysis, check out MLIV Go on the Bloomberg terminal. That's where you find the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. In China, an increase in COVID cases has led local authorities to reintroduce measures like expanding testing and lockdowns. It's now estimated that a fifth of the country's economy has been affected. That's despite Beijing's call for more targeted, less disruptive COVID-0 measures. Goldman Sachs is forecasting that the S&P 500 and its earnings will change little next year. The firm expects margins will contract due to upward cost pressures from wages, commodities, goods, and services. Goldman urged investors to own defensive sectors with low interest rate risk like healthcare and consumer staples. Billionaire investor Carl Icahn holds a large short position in GameStop. Bloomberg has learned that Icahn began shorting the video game retailer during the height of the meme stock frenzy around January 2021. Shares have lost 71% of their value since then. And the richest person in the world has seen his wealth decline by more than $100 billion this year. According to the Bloomberg Billionaires Index, Elon Musk's fortune has fallen to a little less than $170 billion after Monday's $8.6 billion loss. His stake in electric car maker Tesla comprises the bulk of his fortune. Those shares have fallen 52% this year. And Matt, it raises a question of how much of that is really for fundamental business reasons for Tesla, with concerns around China, for example, and how much of it is key man risk, because this is a man that looks very, very distracted on Twitter.
He does. I do think it's fascinating that even after losing $100 billion, he is still the richest man in the world. If you type RICH, Rich Go, into your Bloomberg terminal, you can see that he's still well ahead of Bernard Arnault, Gautam Adani, Jeff Bezos, Bill Gates, Warren Buffett. So he's still way up there, Anna.
Yeah, we'll see if he keeps tweeting and we'll see what happens to Twitter and all the money he put into it, won't we? Let's tell you what's coming up in the programme. We'll speak to Joost Beaumont, ABN Amro, Senior Fixed Income Strategist. What does 2023 have in store when it comes to fixed income markets? Does he expect rates to fall? Does he think demand for fixed income will return? We will talk about whether we'll see a turnaround for fixed income fortunes in the year ahead. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. More fallout from the collapse of FTX. Digital asset brokerage Genesis is warning that it may need to file for bankruptcy if it can't raise new capital. Societe Generale and AllianceBernstein are teaming up in a new partnership. The two will merge large parts of their equities trading businesses into a joint venture. And Bob Iger takes his first steps toward reshaping Disney. Iger wants his deputies to rethink the corporate structure, and he announces that a top manager is leaving. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, I know it's a holiday-shortened week in the US. It is starting to feel a little bit like that. Plus, we had the distraction of football here in Europe, of course. And that definitely weighed on volumes, actually, in yesterday's session. How does the futures picture look stateside?
Yeah, I mean, it feels that way as well here. I can't wait to go home to the great state of Ohio. And it's a football week for us, too, obviously, as we get to beat Michigan on Saturday in the Horseshoe. So I'm excited for that. S&P futures right now up about 0.2%. So a little bit of gains here as we see the yield on the 10-year come down. 379.32 is the level there. Crude coming back up after the roller coaster ride we had yesterday. Are the Saudis going to boost output for some odd unknown reason? Or are they going to continue with their 2 million barrel OPEC plus output cut? That makes more sense. And so the market is now buying oil, both NYMEX crude and Brent on that. Bitcoin right now is up just a little bit, but this measures the move from, I think, midnight or from 5 p.m. yesterday. It doesn't matter. The point is 15,720 is the level, and that's the lowest level that we've seen basically since this time in 2020. So the lowest level that we've seen in 2 years at 15,718. And the question is, will it fall further as we get more fallout from FTX? Anna, what do you see in terms of, Kailey, what do you see in terms of the U.S. market, pre-market?
God, you remember my name, Matt. Well, I am, of course, always watching crypto-related stocks, but I have my eye on some other movers in pre-market trading this morning, one of them being Zoom. Of course, a pandemic-era darling that is not such a darling anymore. It reported earnings after the bell yesterday, slowest revenue growth on record, plus it trimmed its full-year forecast. So that stock is down about 9%, and remember, it's already down 85% from its all-time high in October of 2020. Tesla, though, is rebounding up about 1%, but it has had a brutal November, down about 20% over the course of this month so far because of headwinds from China and Elon Musk being distracted by Twitter. A lot to watch for that stock in particular. And on the subject of China, of course, we saw overnight Chinese technology stocks under pressure in the Asian trade as we contend with the COVID outbreak. Headlines in China, about a fifth of the Chinese economy is under restrictions for the virus right now. So as a result, JD.com is down about 3%, and you got Bilibili down by a little more than 2% as well. Anna.
Yeah, now time for Europe. Let's have a look at the European picture then. Stocks in Europe up by 0.4%, led by energy, up by 3.6% for energy names here. And this as a result, of course, of all the volatility that Matt was alluding to. We saw that in markets yesterday, went down as low as $82 on Brent, back up to 87 or so as the market dealt with the reports, then denied in terms of what was going on with oil production out of Saudi Arabia. Societe Generale down by 0.7%. They're putting together their equities business, the cash trading bit, and the research part with the same type of business at AllianceBernstein. They're going to have 51%, though, crucially, over at SocGen of that joint venture. And NL in focus, that stock is up by 1.1%. Asset sales at this company. This is an energy business, previously very much a fossil fuels energy business, but they've been buying up all kinds of renewable energy assets. They've got a debt burden now, and now they're having to sell off some of those. So South America, they're reducing their exposure there, and also in Eastern Europe, Matt.
All right, so we'll continue to pay attention to what goes on over there. I'm also continuing to see headlines come across the terminal from Keir Starmer saying that Labour should start a private wealth fund of a sovereign wealth fund, I guess it's called when a country does it, and that the Brexit deal isn't working, but that the UK needs to make Brexit work. It's always interesting to me how conservative the Labour Party is starting to sound. Let's get right now to Joost Beaumont, ABM Amro senior fixed income strategist. And Joost, I want to ask you the same question I asked a fixed income reporter that we had on earlier. Why so much volatility in fixed income? Really, fixed income and FX are seeing a lot more volatility than equities right now.
I think that's largely related, of course, to financial markets now being in a kind of tug-of war about what central banks will do. Will they continue to hike aggressively, or will they have reached a bit of a peak, and will they slow down rate hikes or even stop tightening monetary policy? And that, of course, determines a lot the rates in the bond market. So therefore, I guess we see this volatility spiking.
And is that set to continue, that volatility, Joost, as we still try to grapple with where the terminal rate is and how long we take to get there? Do you think we are near the top, and what does that do to that level of volatility?
I think we will continue to see quite a lot of volatility. Of course, it's still very uncertain times, and I think markets run a little bit ahead of themselves after the US inflation numbers, recently, when they thought, well, okay, the Fed will slow down rate hikes, etc., and so riskier assets actually doing pretty well. The outlook for the economy is still pretty dark. We will enter a recession, a deep one in the Eurozone, a more shallow one in the US. At the same time, we will see central banks being rather hawkish. We've seen it on the Bloomberg wires, comments from central bankers. They need to keep hiking interest rates. So 50 basis points for the ECB is more or less a done deal. We expect 50 basis points more in Q1. But next year will be a different story, to be honest.
And thinking about what the ECB does, Joost, they're also changing the way that the TLTROs program works. So that's the cheap loan program they have to the banking sector. And many banks deciding to pay back early, and there's some changing rules happening there. What is it the banks are going to be selling to enable them to pay back those loans? And is that something we need to be aware of?
Yeah, good question. Yeah, it's actually quite interesting. We wrote quite a note about it, and banks have a lot of excess cash parked at the ECB. So the first means to repay TLTRO loans early would, in my view, be cash that they are not using and is just stored at the ECB. That can already be covered quite a large part of repayments. Otherwise, banks might need to sell some holdings of government bonds or other highly liquid assets. But actually, banks haven't really beefed up these investments since the high take-ups of the TLTRO. Actually, they'll be mainly cash, and maybe they will issue a little bit of more bonds to refinance.
What do you expect from corporate issuance in the coming year, Joost?
I'm not really a corporate specialist, actually, but given, of course, especially if you look for the energy transition, companies in that area need to invest quite a lot. So there we can see maybe a bit of a pickup, but I'm more looking at bank issuance and just finished a bit the supply forecast, and there we've seen, for instance, in the cover bond space in the euro-denominated area, we see in a record year of issuance this year, and actually next year we will continue to see quite large issuance volumes there. And also in the senior non-preferred space, I expect banks to be rather active. So it will be a busy year, and that is, of course, also related to banks cannot rely on the cheap funding of central banks any longer. They need to rely more on wholesale funding. We might also see loan-to-deposit ratios going up again as households need to tap their savings to pay for energy bills, higher mortgage bills, and their groceries. So that also means banks need to issue more on the wholesale market. And of course, despite the recession, we still expect bank loan growth to continue to be positive, albeit less strong than we've seen in previous years.
Joost, you mentioned how there's no longer cheap financing from central banks. We're also focused on what ultimately the terminal rate is, how long we stay up at the peak, but there's also a question of where we get back down to. Are we ever going back to the zero, low interest rate world ever again?
Now, I think that is quite unlikely, to be honest. In that respect, we've really seen a paradigm shift where central banks are now more in tightening mode, governments, of course, in supporting mode, and that's a clear difference from the past, from say after the global financial crisis. I think that is likely to remain the case. But if you look for central banks, next year we will see inflation coming down. You already see pipeline inflationary pressures reducing. Gas prices have come down, food prices are coming down, electricity prices are coming down. So next year we will see inflation coming down. We will see economies struggling. So that will actually also lead to a change in the tone of central banks. And actually we expect the Fed and the ECB already to start cutting rates in the second half of next year.
Joost, thanks very much. Thanks for joining us. Joost Beaumont of ABN Amro. Thanks for coming in to speak to us on the programme. Coming up, we'll continue some of these conversations with Anna Stupnytska, who joins us, Fidelity International global macro economist. Just what are the prospects for recession in the United States next year? How does she reflect on what the OECD has announced, bringing down its estimates for global growth? This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Now, in its new economic outlook, the OECD sees a significant slowdown in global growth next year, but it's not expecting a recession. Joining us now is Anna Stupnytska, a global macro economist at Fidelity International. I think that's on a global basis, not expecting that recession. We can get into the US in a moment, but sticking to the global then, Anna, thanks for coming to talk to us. The OECD predicts that global economic growth will slow to 2.2% in 2023. How does that fit in with your analysis?
I think it makes sense. We do expect a recession in key developed markets as well. I think 2.2, even though of course it's still positive growth, but not a recession. It's still a significant slowdown for global growth. Looking at the sort of the trend that we have seen in the past few years. A recession would probably be around 1% on a global basis. So we are still above that, but it does fit with our view on the recession. And I think it's consensus now. The main question for us is how deep the recession is going to be and how long.
Okay, and let me ask you about the US specifically. How convinced about recession are you there? Because actually, there seems to be quite a range of expectations. I know a lot of economists think we are going to see a recession. If you look at some of the Fed's models, they put quite a low probability on US recession next year.
Yeah, a lot of different estimates. We do think, or our models show the probability of recession is somewhere between 50 and 60%. And this is our base case scenario. We characterize this recession scenario, though, as either a cyclical recession, so a recession that comes about as a result of the shocks that we're seeing, but mainly as a result of policy tightening, or a balance sheet recession, so where rates go so high that it triggers issues or debt-related issues. And we don't see that balance sheet recession just yet, although risk is very high. So we are carefully watching. So our base case is a recession in the US, but relatively shallow for the time being.
Yeah, it's worth noting, you may have just seen on the full screen here that Bloomberg Economics model puts the probability at 100%, which is pretty strong, to say the least. In Europe, is it going to be much worse? Will we see a short, shallow recession here and a much deeper, longer recession in the UK and the EU?
I think potentially deeper in Europe than in the US, obviously given all the issues we know about, and the uncertainty related to the war. The war is still ongoing, and there's no end in sight, it seems. The UK is particularly vulnerable on a number of metrics. We are talking a lot now about the potential issues in the housing sector. And again, the housing sector is cracking across the world in major developed markets. But again, UK seems particularly vulnerable to that interest rate shock, to the income shock that is upcoming. So potentially, yes, recession can be very deep in the UK.
In terms of what we see in other countries, how does it look around the world? I mean, we're always so focused on the UK, Europe, and the US, but of course you've got Asia and emerging markets to think about, as well as the rest of North and South America.
Yeah, well, that's quite a long list of countries. I just want to say, in terms of the housing market, what we are watching, and as I said, this is mainly developed markets, but of course, the hotspots, we know countries like Norway, Sweden, Australia, New Zealand, Canada, this is where the housing markets have been overheating a lot over the past few years and didn't even suffer in the global financial crisis. Now that shock is going through the system, and we have to carefully watch what that means for those countries, but also potentially can it turn into more systemic shock to the rest of the economy.
Yeah.
As far as emerging markets are concerned, as we know, a lot depends on China. China is transitioning. We don't expect that it's going to bounce back really quickly, given all the COVID-related restrictions and, of course, the restructuring, that very complex transition process. So again, very selective across EM, but we do think that Asia-Pacific potentially, excluding Japan, can do quite well as China starts rebounding very slowly in 23.
Anna, just because you brought it up, I would point everyone watching and listening to the Big Take story on the Bloomberg and online today, which talks about the housing market in Canada and how it is deflating in a very material way. If I could just pick up on your point on China, though, I'm trying to get a grip on how that story plays into the growth and inflation picture. Because on the one hand, if China doesn't come online in the immediate term, or at least medium term, that is not great for the global growth story, considering it's the second largest economy. But also in theory, that gives central banks a boost on the inflation fighting side.
In terms of the PBOC, or you mean, yeah, of course,
for the ECB or the Federal Reserve, who wants to see inflation get down, China demand coming back and boosting commodity prices as a result seems like it would make that job a lot harder.
Yeah, no, that's true. Of course, if we see a really big bounce in China growth and demand coming back, that would boost inflation, and that would spill over to the rest of the world. So certainly this is one risk factor in a way. As I said, the base case, we don't expect this to happen. So in terms of that inflation pressure, China is probably not going to be such an issue for the rest of the world. But actually, it doesn't even need to be an issue, because the inflation issue is so well entrenched in other countries that the central banks will still have to continue fighting it and keeping financial conditions very restrictive for a long time.
Well, to that point, Anna, we have heard from central bankers, regional Fed presidents for the Federal Reserve, for example, continuing to reiterate that message. We are going to continue to fight inflation until the job is done. How much of that do you think is the Fed actually forecasting what it will do, and how much is that them just talking the talk to push back against an easing in financial conditions?
Yeah, part of it, of course, is expectations in terms of they're trying to send that message to control inflation expectations to some extent, and it is working. Yes, they're pushing back against the easing in financial conditions, but ultimately they are watching not the markets. They're watching not the survey data, not the soft data, but the hard data. And of course, the hard data is lagging, so inflation, labor market, etc. So they might be sending some signals and sort of preparing the markets for a restrictive stance for longer, which they will have to achieve actually physically, without just guiding the markets, but actually getting there because inflation is so sticky. And actually, they're already in the restrictive territory. And we don't think that the talk, the expectation of the pivot, the long-awaited pivot they've been talking about all year, we don't think it's relevant anymore. They are going into restrictive territory, probably to 5% or so in terms of policy rate. And it doesn't matter what they say, because that is going to continue damaging growth, damaging earnings, and putting pressure on financial conditions.
Okay, Anna, thank you very much for your analysis. Anna Stupnytska of Fidelity. And we'll continue to focus on the global economy. Coming up in the next hour, we'll hear from the OECD's acting chief economist. That conversation at 6:30 a.m. in New York, 11:30 a.m. in London. This is Bloomberg.